I'm going to do a head-to-head spreadsheet fight between the FIRE movement retiree and a buy, borrow, die retiree. And this is two groups of people that both believe in investing, they both believe in compound growth, but they both have completely different mindsets when it comes to finances and life and money. And the more I look into it, the more I just think it's just a scarcity mindset versus an abundance mindset, really, when you break it down. So I'm going to use two people, age 60, $2 million to retire on for the rest of their life, and the completely opposite lives they have with the same money, two different paths. You know, with the FIRE movement, it's almost like a cult following. They believe in just depriving themselves of any form of joy of life. They basically become a slave to a spreadsheet. They must obey the spreadsheet. They need to eat rice and beans and rice. They view themselves as like morally superior to people that enjoy life. And it's sad because you can do both. You can do both, and that's the whole point of it. We're not here just to work 80 hours a week for the rest of your life. They view debt as like a moral failure. And that's why it just gives cult vibes, and I don't like it. And really, the retirement life is not bad. Okay, in this example, I'm using a blend of their 401k and Roth IRA, $2 million, and they withdraw like 4% a year. So they're getting inflation adjusted for the rest of their life, $80K a year on this scenario. And I already know straight away what people that are in the FIRE movement will say. Well, 2 million is not enough. Yeah, they never believe it's enough. It's like, well, we would have more than that by 60 because we're doing even more work and we're saving even more. I don't care about that. The whole point is the math is still the same. 80 in this situation, it's 80K a year. So their actual monthly gross is about 6,600. What does that actually give them? So their net take home is roughly 6,286 a month. And that's going to be inflation adjusted till the age of 90. And their portfolio is going to be worth about $16 million at 90, which they'll be too afraid to spend anyway. They probably log on online to find permission. These are the people that phone up like the Dave Ramsey show and say, I've got $16 million. Is it okay for me to buy a car? It's all the mindset. And it's just, what a sad way to be. It's just, why is that? You're like, this isn't life. Life's to be enjoyed. Now, the point with this example, this $2 million retirement, according to the data from the Bureau of Labour Statistics, the average American household spends roughly $6,500 a month baseline living expenses. So they're going to survive in retirement. They're going to have a stable retirement, but they still need to check things. They're still living a monitored life. You see the problem here? It's like you've worked all your life, slave to the spreadsheet, and you still need to look at a spreadsheet for the rest of your life until you're 90, 89 years of age, and it's like, can we afford to go out and eat tonight? What I feel like they tend to do is they view themselves as morally superior to other people. So they see people who are going on vacations, going on holiday, and going out and eating out, and they just view themselves as more virtuous because they have to. Like, how else do you cope with it? You spend all your life being frugal. And honestly, like, you need to have some form of balance. You can't just, I get it, right? You can't invest if you don't have any excess free cash flow at the end of the month. So yes, you cannot just spend more than you make. Both of these people in this example, in this spreadsheet, are doing the same thing. They're both investing. but they're just using completely different strategies. So let's look at the buy, borrow, die version. And what I'll tell you right now is I've figured a way that they will have 10k a month after tax for the rest of their life with the same $2 million. So two people, same age, same money, and watch what happens. Right, so $2 million. What have we done with the $2 million? $1 million in a US risk-free return 30-year treasury. Yeah, 5.05% as of today. So it's, what is the saying? Risk-free return. It's a risk-free return, but not a return free of risk, because obviously inflation, but we're going to deal with that. So that straight away, for 30 years, they have a fixed guaranteed income. See, I like this even more than a dividend, because dividends, it's dependent on the company and the company doing well or being able to afford the dividend and not changing that. You can still use dividends for this part of this strategy. I've made many videos where I criticise dividends, but it's not the dividends I'm criticising, it's people that are buying, invested in stocks because of the dividend and no other reason, and relying on it and thinking they can use a strategy. But this is where it comes into play, right? So I'm using a risk-free rate, 5%. Now the rest of the money is split into a portfolio. Growth and defence, 80% NASDAQ 100 and 20% of that into defensive ETF or defensive stocks. So I'm using a 15% on the QQQ and 8% on the defense. And I'm being quite hard on this investor as well, because I'm giving them a margin interest of 6.5%, which is very expensive. They're cheaper than that right now, but I just want to prove the strategy works for this person, even on a high interest rate. If they were sophisticated, they could use a box spread, which would be 3.75%. So it could be even cheaper. Right, so guess what will their net worth be at the age of 90? Well, because they don't sell any shares, their net worth is over $47 million. You see the difference? So how have I actually funded their lifestyle? I'll show you that right now. But what I want to show you is we've got two people with the same money, the same assets, the same age, the same retirement. This person what they're doing is the bond doesn't give them enough money to live on. Okay, of course, right? But it acts as a ballast to the portfolio for a start, protects the portfolio, and it gives them income, guaranteed income. So what this investor is doing is they are withdrawing the difference to get 10k a month. This investor uses margin to make up the difference. So they're paying federal tax, obviously, on the bond income. So what's the gross payout? Net payout of the bond is about $3,800, and the rest is made up from the portfolio margin. So 10k. Yeah, they pay a bit of tax. But obviously the margin debt, or the borrowed money, security-backed line of credit, Lombard loan, whatever you want to use, that's tax-free. And what we do is we increase that 10k a month in line with inflation over the rest of the person's life. So what ends up happening is the bond is acting as the sort of protection at the start, but compound growth becomes ridiculous by obviously like year 10, year 20, year 30. You can see the compound growth is exponential. And what you also need to remember in this strategy that I've used, right? I've used a higher interest rate. And look at the loan to value they're borrowing at the start. They're borrowing like 3%, 6%, 9%. The loan to value is going up until it then just, the curve becomes exponential. Look, what actually happens is, I'll show you the graph. This is the graph of their net worth between the age of 60 to 90. So the debt goes up, but the true net worth is going up. The balance sheet goes up. The gross assets go up. Yeah, compound growth becomes exponential. And do you know the most thing you need to think of though? This is from a cold start. Yeah, this is a complete cold start. So the person is age 60 they've not got any portfolio. Yeah, I've just started the investing journey at 60. You know, so think about it like, if they just started at 40, yeah, okay, I'm going to start growing a portfolio in a taxable brokerage account. Boom. Changes the trajectory of their entire life, because then they start borrowing at like, 60, 10k a month. They're borrowing like 1% at that point. So this is a cold start, and even this loan to value, I still think that's fine. 24, 25%. They're not going to get margin called in that, because they have bonds and defense. Most of the portfolio is bonds and defense. So, yeah, if we were actually being realistic, okay, because honestly, 6.5% margin rate, who's paying that? If we drop it to 3.8%, that's realistic over the stretch of the rest of their life, okay? Because what I've done is I've assumed the Fed never cut rates again. So even with the Fed refusing to cut rates and margin rates being elevated at 6.5%, it's still the loan to value didn't really go higher than 25% anyway. Yeah. So the actual, look at by the age of 90, he's withdrawing like 200k to get the 10k a month equivalent. Okay, because we're factoring in inflation. But realistically, look, the loan to value would be 12%. The 30-year net worth climbs to 49 million. Yeah, so it's the loan. It's because you've got to remember the when the rates cut, the portfolio goes up anyway, because obviously tech goes up with cheap debt. But look at the difference. Yeah, look at the difference. The difference isn't the spreadsheet though; it's the mind. It's always the mind, because both the FIRE retiree. Okay, these are the FIRE retiree very well understand compound growth. They understand it very well. In fact, the FIRE retiree probably checks the compound growth calculator every single day. Every single day they'll check it. They log in and go, right, so how are we doing? I paid in an extra $1,000 this month. Let's see how much I'll have when I'm 60, 70, whatever age is. They know true and well. And the sad thing is they can't even spend the money when they retire anyway. I've seen videos where they phone in the Dave Ramsey show and they're worth millions and they're too afraid to spend. And honestly, I seen a post the other day. I don't know if you know the guy that says, what's the guy? He's famous. He made a Netflix documentary, something about how to live your rich life or something. He had a Netflix documentary. He's a finance guy, and he posted someone from like a comment on Reddit saying, I've got like $70 million. I don't know if that would be enough to retire. At that point, it's like a mental illness. It's a mental illness. And it's never enough, basically. You could give them $1 billion and they don't think it's enough to live on. It's sad. That is sad and frugal and just, come on. Is that the way you want to live your life? But the buy, borrow, die is the mindset. This is not for everyone, because people just can't handle it. They can't handle it. And I could sit and run stress test terminal risk ledgers all day, showing them they won't get margin called, and they'll still be like, nope, I'm too. They would just rather choose to be afraid. And here's another one. The NASDAQ. The first thing people that probably didn't even exist in 1999, 2000 are like, nah, the dot-com bubble. The dot-com bubble. Nope. Don't want it because the dot-com bubble. And I understand this, yeah. I get the fear from the dot-com bubble. But you must understand, these people were gambling. They had absolutely zero investing knowledge, and they deserved to get an 80% crash. Yeah, they deserved it, because these were literally... The problem with the stock market is you have true investors, then you have a bunch of gamblers, all in the same vicinity. So the dot-com bubble, people didn't have a clue what valuation was. They didn't even know what that meant. They don't know what price to earnings multiples meant. Don't know anything. Just look. They really think, these people just thought, I'm investing in a little line on a screen. They don't realise that there's businesses behind it. So it tarnishes the name. Honestly, the inception of the NASDAQ, the QQQ, was in 1999. So we've got it's like an Olympic sprinter slips when the gun goes off, and people never forget it for the rest of their career, the rest of their life. Or it's like refusing to fly in a commercial airliner because one's crashed before. That's a good point. A commercial airliner has crashed before. Why would you fly in a plane ever again? Come on, when do we use our brains here? That's why the more educated someone is on investing, the better they are at investing. Because they understand the valuation, they understand why the stock market goes up. I keep talking about this on the channel. Because the average person just goes, oh, why does the line go up? Why does the S&P always recover? And I talk about this always on the channel. The more you understand, the better you are at investing. So if you are a FIRE retiree, there's nothing wrong with it. You will have a calculated stability. This lifestyle is completely dignified, but it's monitored. So before you buy that coffee, you need to check the spreadsheets to tell you it's okay. There's nothing wrong with it. This is the path some people want to take. They're just too afraid of everything, and that's fine. That is fine. Nice survival and somewhat stability. I mean, if the market crashes for the FIRE retiree, they're in even more trouble. They are in even more trouble than the buy, borrow, die investor. Because the buy, borrow, die investor, we've already borrowed a sufficient loan to value, so we're not going to get margin called. Yeah, we're not going to get margin called. And there's ballast protection in the portfolio. There's bonds. The bonds are valuable for protection. And this person here, but honestly, by year 10, this person has no fear. Honestly, they have no fear at this point. They understand the game, and they are not selling any shares. Whereas the FIRE retiree may have to actually sell at the absolute bottom. I mean, really think about that. If the market crashes 30-40% for this FIRE retiree, what do? They haven't got anything else. They don't have bonds. They just use 401ks and Roth IRAs and all the tax wrappers. What is their alternative? It's actually worse for them if the market crashes, because they just have to sell. So they lose that money. Whereas the buy, borrow, die strategist just refuses to sell. They've already withdrew maybe the cash out for the year. So they're just chilling on a beach. They probably don't even know the market crashed. And the next year rolls around and they're like, right, we need to borrow some margin or a Lombard loan. And the market went back up. The market recovered. That was good. Do you see the problem with the FIRE movement? That is the problem. They are more vulnerable to a market crash. I just sort of clicked on that right there. Because what do? Year 3 hits. Boom, 50% wiped out. So what's your annual income now? But hold on, this person here was already on the breadline. Well, sorry, not the breadline. Calculated stability, bare minimum. They can afford to live. But if the market crashes, you get the point. You get the point. Two people, same age, same amount. This is the superior strategy. Far superior. Far, far superior.